Right now, there's more money sitting inside Australian ETFs than at any point in this country's history. By the end of last year, the industry had passed $330 billion, up more than 30% in a single year, and it's expected to cross $400 billion sometime this year. Everyone is buying them. Almost nobody is taught what's actually inside them. By the end of this video, you will know the 10 things worth understanding before you put another dollar into an ETF. Not the marketing version, the version that actually protects your money. This isn't a best ETFs to buy video, and it's not American advice with the dollar sign swapped out. Every example here uses real Australian funds, the real Australian tax system, and the real mistakes Australian investors make. One of these 10 is a tax advantage that investors in America and the UK simply do not get, and almost no finance content explains it properly. I'm saving it for near the end because once you see it, it changes how you think about the other 9. Let's get into it. Number 1. What an ETF actually is. An ETF, or exchange-traded fund, is one trade that buys you a basket of assets instead of one. Instead of buying shares in dozens of companies individually, you buy one unit, and that unit already holds a slice of everything inside the fund. That is the entire appeal. One trade, instant spread. Number 2. Globally diversified often isn't. Here is what most people assume when they buy a diversified ETF, that their money is spread evenly around the world. It usually isn't. Take BetterShares DHHF, one of the most popular diversified ETFs on the ASX. Around 35% of it sits in Australian shares, another 42% sits in American shares. Add those together and more than 75% of your global portfolio is actually concentrated in just 2 countries, even though Australia makes up somewhere around 2% of the world's total share market. That's not a flaw. It's just something worth knowing before you assume global means what it sounds like. Number 3. Owning 3 ETFs does not automatically mean you're diversified. This one catches people out constantly. You buy a global fund, a tech fund, and a growth fund, and it feels like 3 separate bets. Then you look underneath, and all 3 are dominated by the same handful of American technology companies. You haven't tripled your diversification. You've tripled your exposure to one theme, wearing 3 different labels. Before you add a new ETF to your portfolio, check what's actually inside the ones you already own. Number 4. Fees compound too, not just your returns. BetterShares A200, which tracks the top 200 Australian companies, currently charges about $4 a year for every $10,000 you have invested. A traditional actively managed fund might charge around $100 a year on that same $10,000. That gap looks small today. Say you invest $10,000 and leave it for 30 years, growing at around 8% a year before fees. At the lower fee, you end up with somewhere around $99,000. At the higher fee, closer to $76,000. The difference isn't the market. It's purely what you paid to be in it. Number 5. Every ETF tracks a benchmark, and that benchmark tells you what normal looks like. An Australian shares ETF is usually tracking something like the ASX 200. A reasonable passive fund should sit within a fraction of a percent of that benchmark over time, maybe 0.1 to 0.5% either way. If a fund is drifting further than that from the index it claims to track, that gap is worth asking about before you assume the fund is simply doing its job. We're halfway through the list now, and this next stretch is less about what's inside the fund and more about how you actually hold it. Number 6. Bigger funds are usually cheaper, but size isn't a guarantee. A larger ETF generally means lower costs and tighter pricing because of scale. What size does not guarantee is a better return, and there's a real practical risk on the other end. Small, niche ETFs sometimes get shut down by the fund manager if they never attract enough money. When that happens, your units are forced to sell, whether you wanted to sell or not, which can trigger a capital gains tax bill you never asked for. Number 7. Thematic and geared ETFs cut both ways, hard. A thematic ETF built around one narrow idea, artificial intelligence, robotics, cybersecurity, can outperform spectacularly in a good year. It can also fall just as hard because it has no built-in balance. A geared or leveraged ETF is a different kind of intense. Put in $1,000 and the fund borrows another $1,000 on your behalf, giving you $2,000 of market exposure. A 10% market move now behaves more like a 20% move on your money. Both of these have a place for some investors. Neither belongs in a first core portfolio. Number 8, where an ETF is domiciled changes how much tax gets taken before you see a cent. If you buy a US-domiciled ETF directly, the default American withholding tax on your dividends is 30%. Under the tax treaty between Australia and the US, that drops to 15%, but only once you have a form called a W-8BEN on file. Here is the part that actually matters for most people watching this. If you're buying an ASX-listed ETF that happens to hold American shares, something like IVV or NDQ, the fund manager handles that form and that withholding at the fund level. You do not need to do anything. It only becomes your personal problem if you're buying US-domiciled ETFs directly through a broker with American market access. Know which side of that line you're actually standing on. Number 9, and here's the one I promised you. Australia has 2 tax mechanics that investors in America and the UK simply don't have access to, and most ETF content never mentions either one properly. The first is franking credits. Australian companies pay 30% tax before they ever pay you a dividend, and franking credits pass some or all of that already paid tax back to you. A cash dividend yield of 4%, once you factor in Australia's average level of franking, ends up behaving more like 5.5%. That's real money, and it's money a British or American investor holding the equivalent company simply never sees. I did a deep dive into how franking credits work in another video, which I've linked in the description below. The second is the capital gains tax discount. Hold an asset for more than 12 months, and under the current rules, only 50% of your capital gain is taxed. One quiet thing worth knowing, calmly, not urgently. This is scheduled to change from the 1st of July, 2027, when the flat 50% discount is replaced with an inflation-based calculation and a new minimum tax on gains. Nothing to act on tonight, just worth knowing the ground isn't permanently fixed. Number 10. Most active funds lose to the index, and the fix is boring on purpose. Study after study shows the same pattern. Most actively managed funds underperform their own benchmark once you look far enough out, after fees. That doesn't mean active funds have no place. The averages get dragged down by funds competing in markets that are already heavily analyzed, mainstream, closely watched ones like the ASX 200 or the S&P 500, where thousands of professional analysts are already pricing in the obvious information, leaving very little edge for anyone to find. Active management has a genuinely better track record in less efficient corners of the market, small companies, emerging markets, or specialist credit, where far less analysis happens and a skilled manager has more room to find something the market has actually mispriced. If that's where your money is going, or you specifically want a manager who can pull back risk in a downturn, rather than simply riding the index down with everyone else, active can be a deliberate, reasonable choice. What doesn't hold up is paying an active fee for a fund that's quietly just hugging the ASX 200 or the S&P 500 anyway. For the mainstream index exposure most people actually need, the unglamorous response is to pick a small number of ETFs that match your goals, automate a regular contribution into them, and leave it alone. Don't chase whatever performed best last year. That instinct alone costs the average investor more than almost anything else on this list. So here is the recap. What an ETF is. Why global rarely means global. Why 3 ETFs can secretly be one bet. Fees that compound quietly in the background. Tracking error as your early warning sign. Fund size cutting both ways. Thematic and geared funds for experienced risk only. Domicile deciding who handles your tax paperwork. Franking credits and the CGT discount. The 2 advantages this country hands you that most of the world doesn't get. And underneath all of it, knowing where active genuinely earns its fee and where it's just an index in disguise. Here are your tonight actions. 1. Open whichever ETF you already hold, or one you're considering, and look up its actual country breakdown on the fund manager's website, not the fund's name, the real numbers underneath it. 2. If you hold more than one ETF, pull up both fact sheets side by side and check their top 10 holdings. If the same 5 companies appear in both lists, you know exactly how diversified you really are. 3. Check the management fee on anything you're currently invested in. If it's sitting above around 0.5% for a broad plain index fund, ask yourself what you're actually paying extra for. Before you buy a single ETF tonight, there's one question worth being honest with yourself about. If you're carrying debt that costs more than around 8 to 10%, a credit card near 20%, a car loan, buy now, pay later, buying an ETF before clearing that isn't diversifying. It's choosing a lower, uncertain return over a higher, guaranteed one. We said earlier that ETFs return somewhere around 8% over the long run. If your debt costs more than that, the order matters more than the ETF does. ETFs aren't the first rung. They're the last one, the long game. There's a very specific order Australian money should move through before it gets there, and most people are never taught it. I have a whole video that walks through exactly that order, the 5 rungs, and exactly where an ETF belongs in that sequence. If you've got any debt sitting in your name right now, watch that one before you open a brokerage app tonight. That video is right here, and I'll see you over there.